Hi, my name is Alex CARLUCCI with Gustan Cho Associates. I want to talk to you about you preparing to buy a house and you going on Zillow or Google and trying to calculate your payment, and I give you the bad news that that's not what your payment's going to be. So let me tell you about Zillow and all these websites. They assume 20% down, they assume 800 credit scores, and they assume very cheap insurance, so the payment looks very low. It's possible to get these insurance rates, it's possible to get those interest rates, but it's not probable. So they're giving you the lowest possible payment that would exist for the most perfect person in the world. So, which isn't wrong, so I'm not saying that they're wrong, but they're tricking people into thinking that that's what the payment's going to be for people who have 3.5% down and are going to have PMI and go FHA. It doesn't calculate that, it doesn't describe that to you, and they're not designed to do that. So trying to calculate your own payment from the internet is very tough, but let me tell you what the inputs are on a payment. So if you want to break it down yourself, you can try it. Let's start with FHA. FHA, you can go to a mortgage calculator, and if you've got low credit score, I would use a higher interest rate than the going rate you're seeing on TV. If you got an 800 credit score, then go ahead with the lowest rate you're seeing on TV or wherever you Google. I want you to be conservative with that rate. I don't want you to put that lowest rate in there because you never know what the adjustments might be. So like right now, a perfect person might have a 3% interest rate, and an imperfect person might have a 5% interest rate. So be conservative. If you think your score is borderline bad, go with the 5 and qualify yourself and calculate the principal and interest. That's the first part of the equation, principal and interest. So there's mortgage calculators on the internet that can calculate principal and interest. The other part is taxes. Property taxes, people don't really understand how that affects their payment because they want to know what their max purchase price is. And I say, I need to know what the taxes are. They say, why? What's the max I qualify? Well, part of your payment is taxes, and the payment is what you qualify for, not a purchase price or a loan amount. It's about the payment. It's about the debt to income ratio that the payment is. So in the payment is going to be taxes. So if you see the taxes are $6,000 a year, you divide that by 12, $500 a month. So you put $500 a month below your principal and interest that you calculate on the calculator with a conservative rate. Now, insurance. Insurance is a wild card. It depends where you are. If you're buying in a hurricane zone, $3,000 a year. If you've got great insurance history, you're buying a $200,000 house, and you're nowhere near any kind of horrible natural disaster type things, maybe you're going to get it for $700 a year. Whatever you think, you'd be conservative. I'd be conservative. I use $1,200 as a rule of thumb, so it's $100 a month. So I put $100 a month there. We don't know until you actually get your insurance, but you choose $100. So principal and interest that you calculated, the taxes are $500 because the taxes are $6,000 a year. I use $100 a month for insurance because it's $1,200 a year divided by 12. Everything's monthly. So now you got principal, interest, taxes, insurance. Now, if it's a condo, we need to know HOA. If it's a townhome, we need to know HOA. HOA dues. So HOA dues, $200 a month. Add $200 a month. I'm just making something up. I don't know what the HOA is. If it's not a condo, there's no HOA. And here's the more complicated one. If you're doing 3.5% down FHA, it's 0.85 times your loan amount percent divided by 12. So on 200,000 it might be like 150. So that's part of the payment, and that's what these websites that you see don't have in there, the PMI, because they assume 20% down. They assume a much lower loan amount than the purchase price too, because they're using 20% down. So make sure you get that PMI in there. Now, if you're doing conventional, PMI factors are based on credit scores and not based on down payments. FHA is based on down payments. So if you put 5% down or more, FHA is 0.8 times the loan amount percent divided by 12. If you're going conventional, it could be as low as 0.15 all the way up to 1.9. I don't know, it depends. So conventional, be conservative, use a 1.1% factor. Now the lower your credit score, conventional starts getting nastier and nastier. The better credit score, the larger your down payment, up to 20%, the less your PMI is. It's really complicated. I don't recommend you try to get an exact number at home, but if you want to get some rough ideas, don't go off the websites. Get a mortgage calculator, get your principal and interest by calculating your loan amount, which is the purchase price minus how much money you plan on putting down. So that's your loan amount. Get the taxes, get the insurance, get the PMI, that's the tricky one, and then HOAs if it's a condo. Now, if you're in a flood zone, that's a whole other world, but let's not get into that. So that's how you calculate a payment. basically, so a lot of people, when they call me, they said, well, the website said $700 a month. I go, well, that's 20% down with 800 credit score. You got a 560 credit score. You're putting 10% down, and you know, it's a little different. So, just want to let you know that's how you do it. Now, VA has no mortgage insurance. Conventional does up to 20% down. So you're doing conventional, and it's 20% down. There's no PMI. VA never has PMI. But they all do have principal and interest. They all have taxes. They all have insurance, and they all have HOAs if it's a condo or a townhouse. Now, veterans, if you're disabled, you are exempt from taxes, but we have to qualify you and close you with taxes in your payment until you go apply for your exemption at the VA or at the county assessor's office. You bring your disability exemption in, and they'll remove your tax bill up to a certain dollar amount. So a lot of veterans want to know why they have to pay taxes when the internet says they don't have to because they're disabled vets. The underwriters, the banks, have it set up where they don't automatically grant that to you because you have to go apply for it and get it. So they don't just assume you're going to go do that. You know, like I haven't gotten my sticker for my plates yet because I haven't gotten up and done it yet. So I haven't gotten the sticker for my plates. So if I get pulled over because my sticker's expired, it's because I didn't get up and go do it. So you have to get up and go do it. That's why they don't give you that exemption when you close on the loan. So complicated stuff. You got any questions with all this nonsense I just said, you give me a call, 630-915-7550, and please subscribe.